Hey, welcome back to Accelerated Investor. This is Josh. I'm so excited that you're here. On this podcast episode, I'm interviewing Dr. Richard Smith. He's the founder of Risk Smith. And we're going to have a conversation today about understanding your own behavior when it comes to making investments. And in uncertain times like these with coronavirus, we need to understand the risk of our investments, how to calculate risk. And he is a Nobel Prize winning, he's going to leverage some Nobel Prize winning research to show you how to remove emotion to make successful investments. So when you're about to hit the button to make a trade, or you're about to sign a purchase agreement to buy a piece of real estate or sell a piece of real estate, that you can have the confidence to know that you're making the right decision in building your long-term wealth. I'm excited to have Dr. Richard Smith on the Accelerated Investor. I hope you enjoy this interview. Take a listen.
Welcome to the Accelerated Investor Podcast with Josh Cantwell. If you love entrepreneurship and investing in real estate, then you are in the right place. Josh is the CEO of Freeland Ventures Real Estate Private Equity and has personally invested in well over 500 properties all across the country. He's also made hundreds of private lender loans and owns over 1,000 units of apartments. Josh is an expert at raising private money for deals, and he prides himself on never having had a boss in his entire adult life. Josh and his team also mentor investors and entrepreneurs from all over the world. He doesn't dream about doing deals. He actually does them, and so do his listeners and students. Now sit back, listen, learn, and accelerate your business, your life, and your investing with the Accelerated Investor Podcast.
So welcome back to Accelerated Investor. I'm here with Dr. Richard Smith, and we're excited to have this conversation today. Thank you so much for joining us. And Richard, why don't you just jump in right off the rip and tell us a little bit more about, with all of your background and experience in market cycles and investing, what are you working on right now today in the middle of this coronavirus pandemic? What are you working on that you're excited for? What new information are you learning? What are some things that you think that you're most excited to tell our audience that you're working on today that might help them with their investing going forward?
Well, thanks, Josh. It is great to be here with you and your audience. So thanks very much for having me. And, I'm really excited about one thing in particular, and that is how can I use technology to help individual investors really master what I regard as kind of the last mile problem of successful investing.
And what is that last mile? What do you mean by that?
It's human behavior.
Yes.
So
that darn thing called emotion.
For something called emotion, but it's it's more than just emotion, because we're heart, but we're also head, and we also are like physical, right? So sometimes, have you heard about that study of like Israeli judges who, they're less forgiving in parole, hearings, like an hour before lunch,
Oh.
They tend to grant more parole when their bellies are full and less, right about when it's time to break for lunch.
Oh, wow.
So literally there are so many drivers of our decision making that people don't really understand. And look, I'm a data guy. I'm a math guy. I love the data. I love the analytics. I love the numbers. At the same time, the central factor in all of your decision making is you.
Right.
And so I think there's an incredible opportunity with technology today, and especially how intimate technology is becoming in our lives and how much it's with us all the time.
Right.
In particular in our mobile devices and even wearables, that I think there's a huge opportunity to, for those people that are willing to, be, who love self-knowledge, right? And who are willing to examine themselves and want to, self-actualize, let's just say, who want to continuously improve. I think there is a cohort of people out there that want to do that. And there's a lot of people who have, really want to be involved in the markets, but have been burned
Sure. No doubt.
Because the markets are really tough. I always tell people it's sort of like, you're starting out investing, right? And you have good intentions, but it's sort of like you're walking into the MMA octagon and you haven't even been to the gym.
Yeah. Not really sure what to do.
Not really sure what to do. And not that you're not sure what to do, but there's lots of people out there who are sure what to do.
Yeah.
And they are going to eat your lunch, bro.
Yeah.
And, and that's just how the markets are set up. So look, there's the last mile of successful investing and speculation in all its forms is, the behavioral enigma. And
so
I think Dave Ramsey in the personal finance space has done a great job of bringing people's attention to behavior. Like he says, it's really 80% behavioral and 20% informational, and I agree with that. So that's what I'm excited about. I am actually developing new financial technology that I call behaviorally informed. So how do we give people a user experience and interaction with the markets that not only presents, the right data at the right time for you, right? But also really incorporates some of the technology available to us today to help you kind of better self-assess, get a better sense of your own risk tolerances,
right,
and really execute. Because that's the biggest problem that I see individual investors have is that we're jumping from one thing to another,
No doubt.
and we don't really self-assess. We don't select a strategy that's going to be a good fit for us and then execute like nobody's business. That's what it takes to be successful. You want to know what differentiates the winners from the losers in the markets? It's consistency.
Yeah.
And people are inconsistent, It's like, oh, that didn't work. Let me go try something else. Oh, that didn't work. And I'm just speaking from my own experience, Yeah. I was literally, when I started investing, I was finishing up my PhD in the mathematics of uncertainty, right? And it's 1998 and I get in the market and I run my account up 300%, man. I'm patting myself on the back going, geez, what a brilliant guy. It must be the PhD. And then March 2000 hits. And I'm literally like an expert in the theory of risk, but I'm like a deer in the headlights, man. I'm just like flat-footed, I'm lying to myself constantly about what I'm going to do and when I'm going to do it and why I'm going to do it, Oh, well, God, I'm down 25%. Well, can't keep going down from here. If it just goes back up another 10%, I'll get out then. I'm not going to get greedy. And then it goes back up another 10%. It's like, well, God, that's up 10%. Might keep going up. Maybe I'll not get out from here, right? So, we're telling ourselves stories and not following the rules. We're like, like dust in the wind. So,
moving.
And it doesn't matter how smart you are, how intelligent you are, how many tools you have in front of you.
So how do we, Dr. Richard, how do we start to harness the couple things that you mentioned? So to start to unpack that with a couple things that I just heard that I think that our audience is thinking is, all right, so if it's 20% knowledge and 80% behavior, what are some tools or mindsets that allow us to harness the proper behaviors to consistently do that? Is it taking a longer term approach and not worrying about the day-to-day so much, because we know that if we're convinced that a certain strategy will work long-term in the stock markets, in the real estate markets, we know that strategy is going to work. We've been educated on it. We understand it. We're convicted in it. But something bad happens in the short term. The behavior could say, I don't want to do that anymore. But you've already convinced yourself that it's going to work if you do it long term. So is that a part of that solution? If we have the proper data, then on the execution, like so many people analyze, then all of a sudden they're ready to click the button to buy those shares of stock, or they're ready to sign the purchase agreement to buy that piece of real estate, and then they freeze, even though the knowledge says this is the right decision, but the emotion says I'm scared, I'm fearful. Right? How do we get beyond? Because behavior and fear, behavior and execution is, when you have the knowledge, then there's that second step, which is like you said, it's that last yard, it's that last mile. And so many people are like, and then they finally do it. Then they do something wrong, and then they never jump back in. Right.
Yeah. So I got a couple answers to that question.
Mm-hmm.
One is I just have to tell you about probably what I think is the biggest behavioral bias that undermines people being successful in the stock market and probably in most all speculative activities. All right.
Mm-hmm.
And I'll get to something more concrete after this. But look, it really is important to understand how you work,
Mm-hmm.
right? I think it's the most important thing, actually. So 2 Nobel Prizes in economics have been awarded now for pointing out the fact that we hate to lose.
Mm-hmm.
Okay? Daniel Kahneman in the early 2000s, he was, along with Amos Tversky, the founder of prospect theory and kind of credited with the founding of behavioral finance. And then more recently, in the last few years, Richard Thaler, who was Daniel Kahneman's student. He's at MIT now. And he got the Nobel Prize in economics for adding to Kahneman's Nobel Prize work of We Hate to Lose. I mean, how shocking is that, right?
Yes.
You can get a Nobel Prize for that? Wow.
I hate to lose. I wish my daughter hated to lose last night at volleyball. They were having too much fun and they got their butts kicked. And I had to tell her, I mean, I know it's summer sand volleyball, but you got to hate to lose.
Yeah, it's not a problem that we hate to lose, but so here's the rub, okay? When it comes to investing, at least. I'm not sure this applies to volleyball and life, but let's talk about investing for the moment. We'll see.
In my newest real estate investing book, The Flip System, you'll learn the proven secrets and strategies that I've used to be a successful real estate investor. You'll also hear the story of my journey from quitting my job to doing over 2,000 units of apartments. The Flip System is now available for a limited time, and you can grab your free copy at getflipsystem.com/podcast. You'll learn the same proven principles and secrets and investing strategies that I used to quit my job and pursue a life of financial freedom. In this book, I'm sharing exactly how I was able to personally close over 750 profitable real estate deals, make over 400 private lender loans, raise over $30 million, and acquire over 2,000 units of cash flowing apartments. Get my newest book now for free at getflipsystem.com/podcast. That's getflipsystem.com/podcast.
So the fact that we hate to lose has different consequences for when we're losing and when we're winning on an investment. Okay? When you are losing on an investment, when you're down, when you're in the red, okay, you don't want to sell.
Right.
Because selling means loss.
Yeah.
Okay, so you have a behavioral mechanism for staying in your losers. Okay? And you will double down, you will triple down, you will say, well, this was a short-term trade, but now it's a long-term investment. You know, you will rationalize to yourself why this is the right decision to stay in this loser until, and this is what Richard Thaler got his Nobel Prize for, you get back to break even.
Yes.
Okay, so anytime you hear yourself say in your little old head, I'm going to get out when I get back to break even, you should get out now because you are not in the right state of mind to be successful. Okay, and I still struggle with this today. I'm a freaking mathematics, PhD in uncertainty. I'm a 20+ year market veteran. I've helped tens of thousands of investors. I've taught about this. I've lectured on it to audiences, and it's still hard for me today. Okay. So this is simple stuff, but it's not easy stuff. These are very powerful, probably, ingrained urges in us to protect us. Right.
Right.
And so I've covered kind of what our state of mind is when we're underwater on an investment and we don't want to sell and we want to get back to break even. Okay. Now, on the flip side, when you're ahead on an investment, the fact that you hate to lose attaches itself to your profits.
Yes.
So you become attached to you become fearful of losing your profits. What does that make you want to do?
Hold on forever.
No, it makes you want to sell because you don't want to lose those profits, right?
Yeah, sure.
So you don't want to lose your profits, so you have an urge to sell, okay? I had the good fortune, the luck to buy Tesla, on the recent market correction at like $415, right?
Yeah. What is it at today?
It hit 1,800.
Yeah.
I don't know where it's at today. I got out because I couldn't take it anymore. I sold it at 1650 or 1675, because it was intolerable to be up 400%, in 3 months and hold on to that, because I couldn't take it anymore. Right. And, I'm not complaining, right? That was one of the best trades of my life,
Yeah, sure.
But still I could feel those powerful urges. So the way Kahneman put it and what he got the Nobel Prize for is we are risk seeking when we're losing. We take more risk when we're losing. We put more money into it. We double down. We hold it for longer periods of time. Okay. And we are risk averse when we're winning. Now the markets can remain irrational longer than you can remain solvent. Have you heard that one?
I have.
That is John Maynard Keynes, I believe. Okay. What that speaks to is that the markets have momentum. They do things that are outside of what they're expected to do all the time, right? So they do 2, 3, 4, 5, 6, 7 standard deviation events. You hear Nassim Taleb talking about this, and they do crazy things, right? I mean, this coronavirus correction was nuts. It was 40% in like 3 weeks, right? And then rocketing back up, that's not what the markets are supposed to do. That's supposed to be statistically impossible, but it's not. That's the way markets behave. So the fact that you are risk seeking with your losers and you're risk averse with your winners, when those market, outside the norm events take place, you are, because of your psychological bias, you are in a position to be victimized by them and not to capitalize on them.
Wow, that's powerful.
Okay.
So how can people, how are people victimized? Is it now that you're victimized, almost, they call it like when you're playing poker, they call it being on tilt, right? So if you're losing, and you're even losing more, and now margin you're willing to take on more risk to make up for the money that you lost.
Are, using their stimulus funds to trade and Robinhood.
Yeah.
You think that's going to end well for them?
Yeah.
I don't, and again, it's like stepping into the octagon and you haven't even been to the gym. So people need to take a step back. I'm a big fan of people engaging in the markets. That's what I'm doing. I'm helping people to learn these lessons, faster than I learned them, to bring some risk management and mathematics to the table, right? So that's another thing we can talk about. And then couple that with how do we leverage technology today to really help us adopt better investing behaviors. Technology is a very powerful behavior shaping asset, right? Unfortunately, the ones doing most of the behavior shaping are Google and Facebook and Twitter,
Instagram,
and the propagandists of the world, right? They're shaping our behavior through technology. So how about we use technology to shape our own behavior in the directions that we want to go, that so we elect and opt into ourselves, instead of somebody else electing for us.
Yes, I was going to ask you, so if you were going to give some advice to our audience or to your younger, less experienced self, now that you've been in the markets, PhD, working on through the cycles, 20 years, and you're advising thousands, tens of thousands of clients through your technology platforms that you've sold off and the ones that you're developing now. What is some specific advice that you think, maybe 2 to 5 pieces of advice you would give your younger former self or some of our audience or some of your clients on how to more effectively be an investor today using some things you talked about, technology, behavior? What are some things you could pass along in that way?
Yeah. So you have to be risk averse with your losers and risk seeking with your winners.
Ooh, I like that.
You have to invert the state of mind that you're in by default and that almost everybody is in. Okay. And the simplest way to do this is with a trailing stop loss. Okay. So that's how I discovered this, because in 2005, I founded a product called tradestops.com. Mm-hmm. And it was a trailing stop loss alert service. Okay. 25% trailing stops was the most common thing that people did on the platform. And they would just, hey, I bought this stock and I want to track a 25% trailing stop on it. And, keep track of it for me and send me an alert when my stop gets hit. Right.
Okay.
So what a trailing stop does is it limits your losses. Okay. Right. So you set a fixed level of loss that you will tolerate. Right. Mm-hmm. And then as your profit increases, that trailing stop loss will trail your profits and always be a fixed percentage, below your profits. Right. So you are locking in profits. Right. And you're setting a fixed percentage where if the loss expands beyond that, you will exit. Okay.
Nice.
But what you're also doing is you're giving yourself a mechanism to let your winners go crazy, to stay in your winners longer than you ever imagined possible.
Yes.
To achieve what I call irrational profits, right? Right now we take irrational losses and rational profits. Let's take rational losses and irrational profits. Okay. Let's let the market's madness work in our favor instead of against us. Mm-hmm. So look, most of the time, the way investing plays out, you have a bunch of singles, right? You have a couple doubles, and when I say singles and doubles, I'm talking about losses and winners. Okay. Mm-hmm. So a single can be a loss, a single can be a gain, right? It's like, maybe let's say it's a 10% gain, right? And then occasionally you have some 50%, losses and gains. And so you know what it takes to recover from a 90% loss, right? If you're down 90%.
I don't know the number, but I know simple math is, I used to talk about this when I sold financial products.
Yeah.
If you go from $100 and take a 90% loss, you're down to $10.
$10. And
now to take the $10 back to 100 is not a 90% gain.
No.
So 99% gain on $10 is $9.
10 is 100, so it's 1,000%.
Yeah.
You got to have 1,000% gain to recover from a 90% loss. Have you ever had a 90% loss? I have, right? Have you ever had 1,000% gain? Those are darn tough to come by.
Yeah, darn tough to come by.
Because we don't allow 1,000% gains. I couldn't endure 1,000% gain in Tesla. I couldn't hold on. 400% was all I could take. Why not?
I love it.
I love it. Why not hold on until Tesla goes to 5,000 or 10,000? That's not outside of the realm of possibility.
Sure.
They are transforming an industry. And they are the technology leaders in an industry that's going more and more technology.
And are you tempted to buy back in and then ride it?
I am. I just think that it's going to be available at a lower price, sometime in the future, right? But look, that's just a speculation. The bottom line is I sold,
Yeah.
And I didn't hold on for 1,000% gain in Tesla, right? So, and again, look, this is just kind of the realities of the markets and the realities of our human psychology applied to the markets, right?
Sure.
So a simple trailing stop loss can be a very powerful tool to make you risk averse with your losses and risk seeking with your gains, right?
Yeah, I like it.
And then I added, later on, I started to incorporate volatility to do what's called volatility budgeting and volatility-based stop losses. Right. Okay. So, a stop loss on a Walmart or Johnson & Johnson, if you want to hold that stock for a year or more, okay, that goes back to your question about time frame, which that's a great topic to talk about. Maybe a 12 to 15% stop loss on those blue chip stocks would give you enough room to make sure you don't get taken out by noise, right? And that you have a chance to get on board a significant trend.
Nice.
On the other hand, something like Tesla or Tether, Tesla or Twitter, you might need to go like 35%, right? Because that's a lot. Those are a lot more volatile stocks. And if you want to hold those stocks for at least, a year or more, there's going to be 35%, noise in those stocks just because of the uncertainty, right? So getting back to my PhD, quantifying uncertainty. So, how can you kind of quantify how much noise there's going to be for a given time frame?
Right.
And you can use volatility as a proxy for risk in that regard. And that's one of the wonderful things about the stock market and the financial markets in general is that they're so data rich, that it's not that hard to calculate, what the historical volatility is on something like Tesla, right? Because you can see what it's done over the past year and you can apply some simple math to it, like a standard deviation. And, how much does this move around up or down?
One of the things
you can
like
factor that into your
audience.
decision making. And that's part of the technology, the new technology that I'm developing right now.
That's phenomenal. One of the things I talk to my audience about, because I often have investors who are in the markets and they're trading stocks or they're in mutual funds and they have a managed account and they want to get into real estate and they have a loss maybe in the markets and they're like, wow, I don't really want to sell it yet. I want to wait, like you talked about, till it comes back to even. I want to break even. Then I'll sell it and move it over to real estate with you and we'll get in this next apartment building or we'll do whatever.
Right. Yeah.
And I often will tell them, look, whoever told you that you had to make up your losses in the same exact position, the same exact stock, the same exact investment, you don't have to make up all the money in the same thing. I remember my dad telling me, oh my God, I'm up 80% in this one mutual fund 1 year. This is back when I was a kid. And then it was down 45% the next year. And my dad said, well, I don't want to sell it now. I'm down 45%. I said, Dad, what makes you believe that you have to make up your losses in the same exact investment? Why can't you just move it over, buy something else that, that you feel better about and make it up over there? So if you have a loss in one position, like you said, be a little bit more conservative with those losses, protect those losses, maybe sell them off, get rid of them, and cut your losses at a certain point. I've had to do that with some real estate deals, Richard,
Josh,
where I was in at a certain point. It was becoming over leveraged. I was over budget. I was over by time. I got screwed by a contractor. And I'm like, you know what? Just get rid of it. Because then mentally, what it did for me, and I would love for you to comment on this, is I was able to exit because you only have a certain amount of power, a certain amount of brain power in your brain that you could allocate to different things. When I exited that deal, it wasn't just about the $50,000 loss I took. It was about the mind share that no longer had to go into that deal. And I could focus now on positive things. And we've been able to make that 50,000 up, tenfold or 20-fold. That to me is, I don't know, people get married to these losses. Like, I'm going to hold on to this asset forever. And then I'm going to think about it every night. I'm going to lose sleep over it. That's the crazy part about investing, that many people just won't say, hey, I didn't do great in this trade, but I got plenty of time. There's always time. There's always the next thing.
No, it's crazy. You're absolutely right. You're spot on. I love that term, mind share. You got to think about that, because it absolutely is about the mind share that you have, in your head and heart. It does stress you out. It takes a toll, and you will be risk seeking with that investment, which has already proven itself, by the way, to not be worth your time and energy. And you're going to invest more in it, right? You're going to invest more time and energy into it instead of just letting it go, when as a business person, you can look at it and go, hey, this isn't the smartest use of my money right now. So this is, exactly, it's called the sunk cost fallacy, by the way. And because we have sunk cost in it. So we don't want to let it go, plus the fact that we hate to lose, and we don't, and it's so egotistical, right? I mean, when you think about it, it's just crazy. It makes no sense. I mean, there's 10,000 stocks in the US stock market. Why does one stock matter? And is it a personal, criticism of you that you bought a stock and it went down? Or you bought a real estate investment and it went down? Is that a personal failure? I mean, is that somehow a judgment? Are you going to go to hell? It's like, that's how seriously we take it, right? And it's really irrational.
Are you ready to automate and explode your real estate investing? We're searching for extremely motivated individuals who are sick and tired of wasting time and want to finally see real results from their real estate investing business. We're searching for investors looking to get to the next level and become a bigger, better version of themselves while being a more successful real estate investing entrepreneur. Apply for mentoring and coaching at joshcantwellcoaching.com/podcast. That's joshcantwellcoaching.com/podcast. All those reasons that you mentioned, like I feel like a failure, I have sunk costs in it. Yeah. And I think for a lot of people, the concept of money is limited and money is not limited. The world can be as big as we want it to be. Our ecosystem, the money that we can use, there's leverage that we can take in real estate deals. We can bring in other people's money. In your world, you can get margin accounts and other dollars to use to make up those losses. It's because people think the money that I have is a finite amount of money. And that's not how the world works. Just because I lose doesn't mean there's always somebody else that has to gain. It's always, there's always more opportunity. There's always more dollars. I mean, Warren Buffett made his fortune off of other people's money. Everybody knows that he started that business and didn't put a nickel of his own money into it. Now he's super rich because he believed that if he knew what he was doing, people would invest with him. He could use their dollars to earn a fee or joint venture with somebody or partner with somebody to make up those losses or to make another investment. So mentally, why do so many people hang their hat on the fact that money is so limited? I only have X amount to work with, and they don't have a much bigger idea of where money goes. Money is always going to flow into good investments. There's always joint ventures happening, partnerships happening on companies and deals. But so many think all the money in the world is just a little bit of money that I have to trade with or to invest. That's not the case.
Yeah. We're sadly in the United States, for as successful as a society as we are, we're criminally illiterate when it comes to finance and math. I can't figure it out, man. It's like, how did this happen? How can it be that in the United States of America, people can be so financially illiterate, so mathematically illiterate, that you don't understand something as simple as expected value, that you don't understand how money works, and that we have so many messed up, ideas and emotions around money, right? So, about this time in most of my interviews, people are saying to me, yeah, well, Richard, tell me what I can really do. Give me something specific, give me a silver bullet. Tell me a stock I can buy or a tool I can use or something, right?
Sure.
But this is the hard reality of being successful. You got to deal with yourself. You have to make sure that you're literate. You have to understand the time frame that you're working on. You have to understand this is a journey and not an overnight thing. I was at a conference, an investment conference early on in my life as an investor, right? And one guy got up and said, hey, here's how you can make 12 to 15% a year with only a few hours of work. And the next guy got up and he said, who wants to make 12 to 15% a year? He said, who wants to make 100% a year trading options?
Yeah.
And then Mr. Math PhD said, I have to wait a year to make 100%? Right? Like I want to make 100% in a few months. So that's just nuts. That's financially illiterate, right? And that's coming from somebody who has a PhD in the mathematics of risk, right? And has had a job since I was 10 years old. I've been working, making money, paper routes, grocery stores, ice cream stores. I'm not like
nice.
I'm not stupid, and I'm not like it's not like I've never been around money. But we're really financially literate. So what I'm saying is people need to invest a bit in their education. They need to slow down a little bit. They need to realize this is going to take some time. And you need to find out, what are the sort of expected values of the strategies and systems that you're going to use? Where are the dials that you can tune to change that around, right? So like when it comes to stocks, how long do you want to hold your stocks for, right?
Mm-hmm.
Now, I personally think that for most individuals who are going to be in the stock market, they should not even consider holding their stocks for less than 1 year on average, okay? So my philosophy of investing is, how do I build a portfolio of 15 good, uncorrelated investment ideas? That's what Ray Dalio called the holy grail of investing. 15 good, uncorrelated investment ideas. Now, there's not really a lot of tools out there that do that for people today. In fact, especially for the average individual investor, right? Maybe, for a financial advisor, you've got tools and you've got, back office staff that can do that for you, right?
Sure.
But this is not out of the reach of the individual investor. And this is part of what I'm working on as my new technology. But, I think the average holding period in the markets lately is something like 8 months, 10 months for a stock, right?
A little shorter.
It's very short, So again, it's about how do you differentiate, how do you separate yourself from most of the participants in the markets, hold your stocks for longer, and depending on how long you want to hold your stock for is going to be a factor in how much risk you need to be prepared to experience, right?
Right.
Like if you want to hold your stocks for at least a year or more, you need, and you're just going to be a buy and hold investor, you need to be okay with probably up to a 50% correction in your portfolio, right? And if you go into it with that mindset and you know that in advance, you're in a totally different psychological and emotional state for what the market throws at you. You might even be like, oh my God, the market's down 50%. That's great. I can buy more at half price. Because that's what you set your setup for, right? But if you're like, you put all your money into the market right now, and a year from now it's down 50%, you're going to throw in the towel at the exact wrong moment in time, like Steve Bannon's father did, selling all his AT&T stock at the bottom of 2008 because he's watching too much TV. And Steve Bannon went on to get pissed at his old colleagues at Goldman Sachs because they all got made whole and his dad didn't. And that helped get Donald Trump elected.
Yeah, how about that? That is phenomenal.
So
that's what people have to deal with. And, it's kind of the hard reality that you got to deal with yourself. Just one last quick thing I would recommend to people. There's a great talk by Warren Buffett's partner, Charlie Munger. It's on YouTube. It's Charlie Munger talking to, I think, a Harvard audience about the work of Robert Cialdini.
Oh yeah.
On influence, right? And kind of the psychology of persuasion and influence. But Munger, like a great investor, applies it to himself, right? And this is what people have to know and deal with in today's world. People know about those influence and persuasion strategies, and they're being used commercially against us to get us to buy things and take actions and make political decisions and judgments all the time, right?
Oh, yeah.
If you don't become aware of how these things work in yourself, one, you're going to be manipulated for somebody else's purposes, and two, you're never going to be a successful investor because the markets will take your lunch money and more because they do know how this works,
That's right.
And so you got to figure this out. You got to figure it out for yourself. You have to give yourself some time. You have to take steps. Another analogy I use often is most investors, you have to think about investing like you would think about learning to fly a plane. You wouldn't just walk out onto the runway, hop into the cockpit of a jet fighter, pull back on the stick, and expect to be alive, in 10 minutes, right?
Right.
So it's a change of mindset, really. It's a reframing, the frames that we use, that we bring to the activities of our lives really matter. And so you got to make sure you have the right frame, and you got to make sure you're in the right state of mind. And that takes a little time,
It does.
and it's wonderful, and going back to the analogy with flying a plane, it's great to fly a plane. Talk about liberating, freeing, exhilarating. But doesn't happen just because you get free trades on Robinhood.
Right.
Yeah. That's phenomenal. That's a great analogy. It's interesting to see how many people that want to be a successful trader, want to be a successful investor, want to be a successful real estate investor,
Yeah.
but only if it happens now. And I think, look, you're going to be alive, let's say for the next 50 years. And if instead of wanting all to have all that success right now, taking a longer term approach to your investments and taking a longer term approach to your own education, knowledge, and understand that you're going to learn something new, that you're seeking new advice, that you're seeking new knowledge every single day, week, month, year. 50 years from now, you're going to retire. I mean, it doesn't have to be 50 years from now. It could be very, very short term. But let's just say it's 50 years from now when you die, you will die wealthy, happy, with peace of mind, sleeping well at night, if you learn a little bit all the time, as opposed to saying, oh, I bought this course, I read this book, I listened to this white paper, I read this, watched this YouTube video. Where's it all at? As opposed to the people that I know that have taken long-term approaches to investing in the stock markets, long-term approaches to investing in apartments, long-term approaches to investing in rental properties and the tax advantages and all the stuff that comes with it. That's really where it comes. And then you could, look, you lost some money today, you can still sleep well at night. Dr. Richard, listen, we've got to wrap up. This has been an amazing interview and time with you. I want to encourage all of our audience to go to Dr. Richard's website. It's richardmsmith.com. He's coming out with a brand new book very soon. You can get on the pre-distribution list there. He's got a ton of resources, articles, and videos there as well. Please engage with him. He's also got his own podcast. If you want to learn more about his investing strategies, his advice, definitely go and check that out. The podcast is called, remind me, I'm looking at it on your website, Understanding Investing Podcast.
Understanding Investing Podcast. And I think we've covered a lot of that today, Josh.
Yeah, absolutely. Listen, thank you so much for joining us today on Accelerated Investor. I had a blast.
Thanks for having me. Me too. Take care.
So, hey, I hope you enjoyed that interview with Dr. Richard Smith. I really enjoyed interviewing him and understanding what it takes to be a successful investor. Not only the behaviors, but the mindset to be able to pull the trigger. If you enjoyed the interview, leave us a 5-star rating in iTunes. Give us a thumbs up on Facebook, some likes, some love on YouTube. Go ahead and show this and share this on all social media platforms and let us know how we did. Again, leave us a rating, leave us a review, send us a screenshot of that rating and review, and we will send you a free Accelerated Investor t-shirt. Don't forget to also join our free Facebook group for all of our Accelerated Investor community. Go to Facebook, search Accelerated Investor, send us an invitation or request an invitation to join our free Facebook group. There we can share ideas. You can interact with me and my coaches and my team directly. I look forward to seeing you inside of our free Facebook group. And thanks for listening to my interview with Dr. Richard Smith.
Hey, Josh here, and do you want to win a free Accelerated Investor t-shirt? All you have to do is give Accelerated Investor, our podcast, Accelerated Investor, a rating and a review on iTunes, okay? Do that now. Then send us a screenshot on Facebook or Instagram or Twitter. What we're gonna do then is every week we're gonna pick our favorite rating and review, and we're gonna send that person a free t-shirt and maybe, again, some other cool, fun stuff as well from Accelerated Investors. So, again, don't forget to take a screenshot. Leave a rating, review, take a screenshot, send it to us so we know exactly who you are. And then once a week, every week on the podcast, we will announce a new winner. Don't forget to take a screenshot and send it to us so we know exactly who you are. We'll announce a new winner every week.
You've been listening to Josh Cantwell and the Accelerated Investor Podcast. Leave a comment on our iTunes channel and let us know what you want to learn next or who you'd like Josh to interview. While you're there, give us a 5-star rating and make sure to subscribe so you can be the first to hear new episodes. Follow Josh Cantwell and his companies, Strategic Real Estate Coach and Freeland Ventures, on all social media platforms now, and stay up to date on new training and investment opportunities. To start your journey toward the lifestyle you've always dreamed of, apply for coaching at joshcantwellcoaching.com.